tonight's presentation. All right, welcome to Meet with an Expert, an introduction to investing. This information session is part of our Maroon Money Month 2026, which is sponsored by DATQ. Tonight, it's going to be very interesting because social media makes investing look really easy, doesn't it? But where should you actually begin? Well, we've got an expert here tonight, Dr. Hee Ren, Assistant Professor of Finance, who's going to introduce us to the fundamentals, the risks, and the options available to you from traditional investments, even going to touch a little bit on crypto. My name is Shalise Connors. I'm the Executive Director of the Student Money Management Center, and let me begin by welcoming all of you to this Information Center. This is our last one for the spring 2026 semester, and it's really exciting because we've had numerous requests to have an information session on investing. The SMMC serves the students on all three of our campuses. We bring you programs such as this one tonight, and so much more throughout the school year. And we do encourage you to follow us on Instagram, on Facebook, and our YouTube channel. Our handle is at TWU Maroon Money. Online with us this evening is Cameron Penny, our Student Money Management Center Financial Resolution Coordinator, and she's going to be assisting with the chat tonight. This program is also sponsored in part by the Spendwell Committee of TWU's Health and Wellbeing Initiative, and we do appreciate the continuing support of their leadership, including one of their co-leads, Stephanie Compton, who is with us tonight. Our featured presenter is Dr. Ren, as I said. I'll introduce him here in just a moment. I just have a couple of housekeeping items. Like I said, a recording of this info session will be posted on our YouTube channel. So please feel free to put questions inside the chat throughout the presentation, and we will get to them. And as well at the end, when we have Q&A, you can unmute yourself and ask a question, or you can put it in the chat. You can switch your viewer to speaker view so that you can see the speaker right there on the right side of your slide deck. And also, if you want to keep your camera off, it does help with the bandwidth sometimes, wherever you are. And lastly, there will be a short 6-question anonymous survey when you exit the Zoom tonight. If you can fill that out for us, that would be very helpful because it helps us with programming, improving what we bring to you guys, and we just want to hear your feedback about tonight's session. Okay. We are very fortunate to have our expert with us tonight to help you navigate the interesting world of investing. Dr. Hee Ren joined TWU as a visiting assistant professor of finance in 2019 and has been working as an assistant professor for 6 years in the Marilee Alexander Kick College of Business and Entrepreneurship. He earned his PhD in finance from the University of North Texas, his MBA from the University of Texas at Dallas, and his MS degree in finance from State University of New York at Buffalo. He finds investing interesting because it functions like a complex, ever-changing puzzle where data, human psychology, and global events intersect, requiring both rigorous analysis and creative strategy to navigate. He is a chartered financial analyst, charter holder, and a financial risk manager. The perfect expert for us tonight. Thank you for being here, Dr. Ren, and I will turn the program over to you.
Thank you, Shalise, for having me this evening. And good evening, everyone. Welcome again to our Meet with an Expert series presented by the TWU Student Money Management Center. I know that for some of you, especially if you are not business majors, the word investing sounds like something reserved for people with 6-figure bank accounts. Well, definitely this is not true. Today is about how to start your own investing journey. So I hope that by the time you leave this presentation, you will feel that I can get my own investing started. All right. So before we start, we'll have to look at this boring slide. Everything we discussed today is for educational and for informational purpose only. So I am a professor. I'm not your personal financial advisor. So this presentation does not constitute investment advice or a recommendation to buy, hold, or sell any specific securities. But you can think of me, as your coach, right? I'm telling you the rules of the game, but you will be the one who has to go go out to the field and play. Okay. Um, so, who am I? And I would like to thank Shalise for introducing me just now. Uh, but I want to introduce myself a little bit again. My name is He Ren. I'm now the assistant professor of finance at the Mary Lee Alexander Kick College of Business and Entrepreneurship. I've been with Texas Women's for almost 7 years. And as Shalise introduced, well, I think I've been trained in the field of finance for a long time, so that I think I can translate what I've learned so far into plain English, hopefully for you today. So without further ado, let's get started. So as the topic of this event suggests, social media makes investing look easy. Is that true? Well, social media has done something dangerous, in my opinion. It has made investing look like a, high-speed car chase. You see some finfluencers. So we have influencers, but now we have a new word called finfluencers. Shouting about turning $500 into 50,000, or maybe showing off a crypto millionaire type of, lifestyle. So how about the reality? What are the realities? Well, most of those people are selling you a dream that, doesn't exist for, I would say, 99% of the investors. Okay. Most people who try to time the market, guessing exactly when is hitting the bottom or the, top, well, actually, they lose money most of the time. Successful investing, so actually, it's quite boring because it's about building wealth steadily over time. It's not hitting a jackpot overnight. Okay, so this is the reality, in my opinion, compared to what we have seen um, on social media. So, um, I would like to share three things that probably you should do before you start your own investing journey. So the first step is to have an emergency fund ready. Okay, so you need to save, or at least have 3 to 6 months of living expenses in an old-fashioned savings account that works as your safety net, so that when you start your investing, well, let's say if your car breaks down, you don't have to sell your investments at a loss to fix your car. All right, so build an emergency fund first. And the next thing you should do is to pay off high interest debts. Okay, kill those high interest debt. If your credit card charges you 20%, most of the time the credit card companies charges, higher than 20%. Let's imagine that you can earn 10% on your investments, which is already a very, very high return. Okay. If the card charges you 20, but you can make only 10%, you are still losing 10%. That's why you want to pay off those cards first before you start your own investing. And the third thing is to know your budget. Only invest money you won't need in the short term. Okay, like, you do not want to touch the money you prepare for the next semester's tuition, right? So know your budget first before you start your own investing. But you may wonder, on your right hand, there are four stairs there. So why are there four stairs? Because the next step is for you to put your extra money to work for you. So let's go to a very important concept in the investment world. The money today is worth more than the money tomorrow. Let's imagine if I give you $1 today, or I promise to give you $1 a year from now. Which would you take? You should take it today. And why would you take it today? Because of inflation. Inflation is, is a invisible thief that makes everything more expensive over time. Or in other words, $1 today is not $1 a year from now. $1 today is actually worth more than $1 tomorrow because money can grow when invested. Okay. It doesn't just sit still. It's not like $1 sitting in your piggy bank or under your mattress and doing nothing. No, that's not the case. Money can grow. At the same time, inflation erodes purchasing power over time. Everything is, becoming more expensive over time. So the fact is, the sooner you invest, the more time your money has to grow. So this is the entire foundation of why investing matters. The money can work for you. The money will grow over time. And we call this the time value of money. So let me elaborate a little bit on the topic, the time value of money. Actually, to be specific, the magic of compound interest, which means you're going to earn interest on your previously earned interest. You earn interest not just on what you invested. Okay. So it's like rolling a snowball. Every time you roll a snowball, there will be more and more snow, attaching to the surface of the snowball. Once you started rolling, it will become bigger and bigger and faster and faster. So your money grows faster and faster over time based on the compound interest. So this is a very simple example that I want to show you. Let's assume that we have $1,000 to be invested. And let's assume that you can earn a 7% average return every year for the next 30 years. So how much money does that $1,000 become after 10 years? It becomes almost $2,000, as you can see on your screen. How about the next 10 years, from year 10 to year 20? Your money does not grow linearly. It's not like $1,000 to 2,000 and 3 and 4 and $5,000. Actually, your money grows exponentially. As you can see here, that 1,000 becomes $2,000 after 10 years and becomes almost $4,000 after 20 years, and it becomes almost $8,000 after 30 years. Actually, the money grows exponentially. It's like 1, 2, 4, 8, 16. It grows faster and faster over time. So as you can see from this bar chart, the money almost doubled after 10 years and then again doubled after another 10 years. So what is the takeaway here? Starting early is the single most powerful thing that you can do. Okay, start your investing early and do not wait and earn the compound interest from your investments. So, what are you investing for? Investing is not, one size fits all. Um, Actually, in the end, your goals determine your investment strategy. Let's say if you have a short-term investment plan and you plan to purchase a car and you're planning for a summer vacation probably 3 years from now, this is considered as a short-term investment period. Well, if the goal is for short term, we would keep our investments in a very safe and stable places that, we're going to talk about later today. But your goal is to plan for a medium term, let's say from 5 to 10 years. If you plan to go to a graduate school, let's say after 5 years after, you graduate from college, or maybe your plan is to pay the down payment on a home. Um, Here, if the term is a little bit longer, we can be a little bit more aggressive here because there is some room for you to make mistakes. But if you are planning for long term, let's say 10 plus years for your retirement or then eventually financial independence in the future, well, since you have time to wait out market drops, maybe in the next 20 to 30 years, then you can go for some higher growth options, some riskier options for you to plan long term. So I'm gonna introduce to you some different investment tools later today. But eventually your goal determines which investment makes sense for you. Just know your goals before you make your investment decisions and choices. So that being said, we've been talking about investing a lot, but what is investing? And how is it different from savings? As we all know, saving is just the storing money safely. It is great for short term because the risk of losing money is almost a zero if you put money in a savings account. But we all know that the return from a savings account is very, very low. On the other hand, investing is putting your money to work. Okay? It carries a little bit higher risk, but it's the only way to consistently beat inflation and actually increase your net worth over the long term. All the common tools, investment tools for us includes bonds, stocks, real estate, mutual funds, and of course, some other investment tools such as crypto that we're going to touch a little bit later today. But one thing to keep in mind before starting your own investments is that we have inflation. Inflation, about 3% a year is constantly shrinking your purchasing power. Well, if you're not investing, let's say if you're not investing, you're falling behind. You're falling behind inflation. You will actually lose money. And one of the most important purpose of investing is to help your money grow faster than inflation. Well, next, I want to talk about the risk and return, which is the core trade-off in the investment world. We all have heard, higher risk, higher return, but there's no such thing as a free lunch in finance. Higher potential returns always come with higher risks. Yeah, let's say if you expect to receive a higher return from your investments, you must bear higher risks at the same time. So I have a question here. Do you think risk is necessarily a bad thing for investors? Is risk necessarily bad? Okay. So actually risk, I would say risk is not a negative word in investing. It is actually a neutral word. So higher risk means there are higher chances that you may lose money, but higher chances that you can make a large profit at the same time is, working in two directions. Risk shows us a time of danger and a time of opportunity at the same time. So I wouldn't say, risk is necessarily bad for investors. It's just a neutral word showing possibilities to two directions at the same time. So some risk return trade-off for different investment tools. Let's say savings account. Savings accounts are, ultra safe, but they just pay on almost nothing, almost 0.5% return if you put your money in a savings account. Let's move down to government bonds. It has low risk with a relatively low return, but for some government, especially federal government issued bonds, they are considered risk-free. They have no default risk. It's not likely that the government will miss any payments in the future. So it is considered a very safe investments that provides you with 3 to 5% return every year. So if you have extra money, by saying extra, I mean after you create your emergency fund, after you set up your goals before you start your investments, you can always put your extra money in a government, especially federal government issued bonds with no risk or with very, very low risk that offers you a 3 to 5% return. That's enough for you to beat the inflation nowadays. And let's move down to stocks, which, I would say at a medium or high risk level that historically offers investors 7 to 10% average return every year. Um, and of course, cryptocurrency, I would say they are very risky. They have very high risks. The price fluctuates a lot, and the returns are highly unpredictable. But overall, again, understand your goal, and your job is to find the right balance for your goals and timelines. And what we should do is to combine these investment tools together to work for you.
Durin, I was just thinking in a lot of coaching sessions, you might be planning on touching on this, but we hear a lot of students talk about high yield savings accounts. It's like kind of
Mhm.
was like a buzzword on social media there for a minute. And so, where would you place high yield savings accounts in this spectrum of risk? And what are the advantages of that over maybe that traditional savings account you already discussed?
I would put the high yield savings accounts between the government bonds and the savings account. But in the end, it is a savings account. But probably they just do different trades on their side that may offer you a little bit higher return at very low risk. But eventually, they are savings account and for a regular savings account, the bank usually put your money in what we call it money market and buy very short-term government securities. When you want to redeem, let's say withdraw money from your savings account, they can sell those short-term securities fairly quickly and get the money ready for you. But for those high yield savings account, I'm not quite sure on this, but maybe they invest your money in those government bonds or long-term government bonds, which offers them a relatively higher return. So when you withdraw money, again, they're going to sell uh, the securities they hold and they get the money ready for you. It's more like you purchase a government issued bonds by yourself. So I would put the high yield savings account between the regular savings account and maybe on par with the government bonds category.
Thank you.
Thank you for your question. So, um, in the end, as I just mentioned, we want to put, different asset classes, different investment tools together in one basket. We do not want to put all of our money like in savings account, let's say, which offers you a low return. We do not want to put all of our money in stocks market, or of course, do not put all your money in the crypto part. So with that being said, I want to move to the next slide, which is diversification. So why do I say combine different investment tools together? I believe you all have heard this before. Do not put all the eggs in one basket. This is the most important rule for your investments. Diversification. It just means spreading your money across different investments. So if one company goes bust, your other investments can hold you steady. Think of it like, a sports team, right? You need different players with different skills and different strength. So you should diversify across different industries, across different asset types, or even different parts of the world geographically. All right. So there are many different ways of diversifying your investments. Let's say investing in 30 different stocks is considered as a way of, diversifying your investments. Let's say for young investors, I would say this is a very good starting mix. 60% of stocks in your investments, 20% bonds, 10% real estate, and 10% money in other areas. Don't worry for now. If you see like stocks, bonds, or real estate, how can we buy those assets and what are those assets? So here I got you covered. What can you invest in? This is just a brief overview of the tools available for you for your investments. And we will, dive into the details of each one of these later today in the next couple of slides. So buying stocks is like just buying a piece of company. So I have an example, like if you buy one share of Apple stock, you can call yourself that, I am one of the owners of Apple, right? So you're actually buying the ownership in a company. For bonds, it's like lending money to a company or to government. So the companies could be the borrower and the government could be the borrower. So when they issue bonds, you can, purchase those bonds and you will be the lender and you will be the bond investor. And for the next group, mutual funds and ETFs, actually, they are baskets of many investments in one. And, we're going to elaborate on this part next. And the next is real estate or REITs. What are they? Like, do you want to be, let's say, a landlord, purchase a property and rent it out and, collect rents? Of course, you can directly purchase a property, but what if we don't have the down payment, let's say, to purchase a property? There are other ways, and we call it the real estate investment trust, which is the REITs here that I'll also show you later. And of course, cryptocurrency, there are digital assets such as, Bitcoin. So again, this is just an overview. Let's dive into these investment tools one by one. And I want to start with stocks. Okay. As I just mentioned, when you buy a share of stock, you are a part owner of that company. Let's say, if the company does well, you can make some profits, right? You can make money in two ways: from the price changes and from the dividends the company pays to you. If the price goes up, you're going to make some profits from selling that stock in the future. And of course, you will receive some periodic dividends, which is a way of sharing profits together with the firm, right? Since you own a piece of company, you have the right to share the profits the company makes, right, in the form of dividends. Okay, there are two ways that you can money if you want to invest in stocks, from price going up and from dividends. Stocks, they have higher potential returns than bonds, but they are more volatile, meaning the price bounces around a lot compared to bonds. Well, you have to think long term, and if the market drops or the market dips, do not panic. Okay, take a long run view if you are a stock investor. So familiar examples, the companies that most of us know could be your target if you decide to invest in stocks such as, Apple, Tesla, Amazon, McDonald's, and historical data shows that the S&P 500, which is considers 500 companies all together, which is a stock index. Okay, we consider S&P 500 as a proxy for the overall stock market. Has an average 10% annual return over the past 50 years. Historically speaking, the stock market offers a 10% annual return over the past 50 years. Does it say that, if you start your own investment today, that you will earn like 10% every year for the next 10 years? Well, here's one thing that I want you to keep in mind, that, past performance is not a guarantee of future return, right? The average 10% return in the past does not mean that you will earn 10% every year in the future. But the bottom line here is that, if you stay in the game long enough, you will at least beat the inflation that will erode your purchasing power over time. So how about bonds? If stocks make you an owner of a company, well, bonds make you a lender. Okay, it's like you lend money to a company or government, and what the borrowers will do, well, they promise to pay you back with interest over a period of time in the future. So overall, bonds are generally safer than stocks. They provide lower returns, but the returns are more predictable. Okay, if you're a bond investor, your returns will be kind of, fixed. You will receive a fixed amount of interest every year or every 6 months, and a repayment of the amount you lend out. So the returns and the cash flows you will receive are more predictable than the volatile stock market. So the bonds are great for balancing the risk in your investment portfolio, so that you can sleep at night. It's not like you just stare at your account and look at the volatility of the stock market. Well, let's say, for example, if you include 60% of your investments in stocks and the remaining 40% in bonds, you can guarantee that at least 40% of your assets could generate a steady and stable income over time, right? So the examples from the bond market include the securities issued by the federal government, the U.S. Treasury bonds, U.S. Treasury securities, which are considered risk-free. They are very safe. That provides you relatively low but not that bad return, like 3 to 5% every year. And of course, there are bonds issued by companies, large companies such as Apple, Microsoft, they issue corporate bonds, which offers you a higher yield, but at the same time, they may default, which means the company will not be able to pay you the interest and repay the amount you lend to them in the future. A little bit more risk compared to the bonds issued by the federal government. And here is a rule of thumb that I want to share with you regarding the balancing between stocks and bonds, which says as your age grows, you should gradually shift from stocks towards bonds. Okay. The reason is that, as a young investor, you still have the ability to work and earn salaries. So you have the ability to bear a relatively high risk of losing money from the stock market. But as your age grows, you will rely more on the passive income, right? You will not be able to earn as much as, you are still like a young person working hard. So you want to rely on a more stable income, which is what the bond provides you. So let's imagine on the day you retire, probably you're going to shift most of your financial assets towards bonds and earn a steady and stable income after that. So how about mutual funds and ETFs? Well, they're considered an easy diversification for your investments. So what are mutual funds and what are ETFs? Well, they are a fund, pulls money from many investors to buy a basket of assets. Well, let's consider the mutual funds and ETFs a basket of assets. Okay, so they've already been diversified. Let's say an ETF includes 30 tech stocks. Okay, they're considered as tech ETF. Right? It's already a basket of assets, a well-diversified portfolio. So the difference between the mutual fund and ETF, which is the exchange traded fund, is mutual fund, they are mostly actively managed by the pros, and they are traded only at the end of each day. But for ETFs, they just trade like a stock. Okay, you can find those ETFs from your brokerage account. They just trade like a stock, and they charge you a very low fees for managing those assets within that funds, and they are very flexible. You can buy and sell those ETFs as you trade a stock. You can do it anytime. And I would say this is a very great starting point for beginners because it is an instant diversification in one purchase. Okay, for example, an S&P 500 index ETF just lets you own a tiny slice of 500 companies at once. Right? It is already a natural diversification for your investments. And there are, of course, some other industry ETFs, like, for example, what I just mentioned, the tech sector ETF. Well, if you're into tech companies and would like to share the profits and losses, of course, in the tech industry, you can just take a look at the tech sector ETFs that includes most tech companies in that basket. Okay, so mutual funds and ETFs are a great starting point for beginners in terms of diversifying your investments. And the next tool, real estate or the investments in property. If you want to be a landlord, to buy a property, rent it out, and sell it later for profits. What if there is not enough money for you to pay the down payment? Because a direct purchase of real estate requires a large upfront capital. It's not always accessible for you and me. So what if you still want to expose yourself to the real estate market and earn some profits from the real estate industry? We have some great tools here, and one being the RAISE, Real Estate Investment Trust. These companies are the companies that own apartments like offices, buildings, and malls, um, and they trade on the stock market just like a regular stock. You can, actually invest with as little as $10. No building required, right? You don't need to own a building to share profits from those buildings, malls, offices. So you can purchase, let's say, one share of the REITs, the real estate investment trusts. And by law, they are required to pay out 90% of their income as dividends to you. Okay, they have to share their profits with their shareholders. So this is a good way for you to get access to the real estate market. And lastly, cryptocurrency. Well, as we know, it is kind of a digital currency, not controlled by government or the central bank, and they are built on what we call it, blockchain technology, and we all heard of the name like Bitcoin, Ethereum, and they can be used for like payments, for investing, and for some decentralized apps. So people are excited about this new technology and this new investment tool. So people now are, think of cryptocurrency as an investment tool, not only a like technology innovation there, because they think, this is like a new financial system without traditional intermediaries. There are not that many regulations right now. It's still under development. And the fact that Bitcoin grew from $1 in the year 2011 to over $60,000, or not as its peak, I think is over $120,000 per Bitcoin, is kind of a hype within the investors and a fast evolving space with real technology innovation. So people are getting excited about cryptocurrency. Sharing all those hypes here, but I'm not a tech expert. I not quite know how the blockchain technology works, how Bitcoin is created. But from an investor's perspective, I would say exciting, yes. But if you want to invest in the crypto, proceed with caution because they are extremely volatile. And you have seen that many times the Bitcoin price dropped more than 50% in the past. And there is no government insurance like what you put in a savings account. And you have seen, I believe, many like scams, online phishing attacks, and some fake things about the crypto. And I just mentioned the regulation is still evolving. Rules could change significantly in the future. So if you invest, please only use money that you can afford to lose entirely. That being said, treat crypto as a small speculative portion of a diversified portfolio. So this is not a get rich quick strategy. If you do want to include crypto in your portfolio, just use a small portion of your money and give it a try. Give it a try. So overall, we have these investment tools, say stocks with a medium high level risk that has a historical average return 7 to 10%, and it is best for your long-term growth. Right? For bonds, is more stable and provides steady income. For ETFs, it's good for beginners, and it is a natural diversification for your investments. And for the real estates and the rates, it offers, again, a stable income, and it is also for your long-term investments. But for cryptocurrency, the average return varies. It's highly variable, and it should be used for speculative purpose only. Okay. So these are all the investment tools that I want to share with you today to get your own investment started. And then the next question is, where should you keep your investments? Okay. So we have many choices here, and the brokerage account will be your standard investing account. It's a very flexible account, with no limits. And there are some other retirement accounts that you can contribute to, such as the Roth IRA and the 401k account. So if you would like to learn more about the Roth IRA, the 401k, and the retirement planning, please subscribe to the Student Money Management Center's YouTube channel, where you will find a lot of resources, among which Dr. Megan Berg from the Mac College of Business and Entrepreneurship talked about retirement planning in details there. So do not forget to subscribe. So, how do you actually start investing? Just have your brokerage platform, have your brokerage account. First, look for a platform with low fees or no fees and no commissions for trading and no account, minimum and, easy to use interface there. There are some popular choices, which includes, Fidelity, Charles Schwab, Vanguard. It's great for your personal long-term investing. And, you are familiar with Robinhood if you just get started for your own investments. Robinhood is a very beginner-friendly with commission-free trades and some new technology in the innovation in the investment and the financial advisory field. If you want a hands-off approach, robo-advisors platforms such as the Betterment, Acorns will do the work for you. You don't need a human financial advisor. They are run by like AI behind the scenes and help you make your investment decisions. Okay, they're called robo advisors. But most platforms now allow, fractional shares. Sometimes you don't have to purchase, at least one share. You can purchase let's say 0.5 shares of a stock. You can start with as little as $1. So from there, I want to share with you just a beginner-friendly best strategy for you to get your own investment started, which is the dollar cost averaging strategy. Well, instead of trying to time the market, decide, is it good time to buy? Is it good time to sell? Don't worry about that. Instead of trying to time the market, you can invest a fixed amount regularly, let's say $50 a month, no matter what. Okay, regardless of the market conditions. Let's just, purchase $50 worth of shares in your brokerage account. So when prices of the stocks are low, you just buy more shares, right? But when the prices are high, you just buy fewer shares. This strategy just takes out emotions out of investing. So for you, you don't need to tell the best or the worst timing of the market. For example, let's say if we invest $50 per month for 10 years, that you can earn 7% every year, your money will grow to $8,700 in addition to the $60,000 you put in your account, right? $50 a month, 50 times 12, like $600 a year and $6,000 for 10 years. But actually, your money will grow to $8,700. So compared to the $6,000 you contributed, the rest is the growth. Okay. Do not try to time the market because consistency beats timing almost every time. So before we leave, I still want to share some common mistakes beginners should avoid. First one, do not wait until you have enough money. Start small now, not later. Okay, do not wait. Do not wait. And do not try to time the market. Even professionals cannot do it consistently. Okay, the professionals cannot beat the market consistently. So do not try to time the market. Tell whether it's a good time or it's a bad time. Start now. And do not panic selling when the market drops. Okay, this turns a paper loss, or we call it unrealized loss, into a real loss. Okay. Since you have your emergency money ready, do not panic when the market drops. Okay. Following social media tips, or do not follow social media tips or hot trends without doing your own research. Okay. Be responsible for your own investments. And do not always follow the social media tips without asking any questions. And do not put all your money in one stock or one asset, because diversification matters for your investments. And lastly, do not invest before building your emergency fund. Okay, so think about these points before you start your own investments. So lastly, some key takeaways and final thoughts. Of course, know your goals, because your goal determines your investment strategy. Is it towards a short-term goal, a medium-term goal, or long-term goal? And diversify your investments. Do not bet everything on one investment, and keep it simple. Okay, you don't have to do a lot of research and do the stock picking by yourself. The indexed funds and ETFs are a good starting point because they are already well diversified for you. And of course, ignore the hype. Slow and steady usually wins. Okay, be patient when you do your own investments. And lastly, do not wait for the perfect moment. The best time to start your own investing is now. Okay, the best time to plant a tree was 20 years ago, and the second best time is now. All right. And that's all from me. Thank you so much for your time.
This has been so fantastic, Dr. Ren. I really do appreciate all this wisdom and the expert advice. We do want to ask our participants, does anybody have any questions? Anybody want to explore a specific concept any deeper? Please put it in the chat, or feel free to unmute. You've got him right here, and so let's use this time. I do want to say that one of the things that we talk about in the Student Money Management Center in our peer mentoring coaching sessions is that time is their greatest asset. And if they have everything lined up, like you said, they don't have a whole lot of high debt, they have manageable income, that even those small, and we also recommend $50 a month, starting in some sort of brokerage account. We talk about Roth IRAs, because the benefits of a Roth IRA, being able to use that income later. It's already been taxed, and so you're going to get it tax-free. So there's so many things, so many platforms and instruments that you can use. And yes, time is of the essence. So start now. But I'm going to stop talking here and just see if we have anybody. Anybody have any questions? Remember, there's no silly questions. I also want to say thank you to Stephanie Compton, who's in our audience today. She pointed out in the chat the library has databases that students can use to research companies. So if you're trying to figure out what portfolio might be good, thank you, Stephanie, for putting that in there.
Thank you so much, Dr. Ren and Shalise. I don't see any questions in the chat, but Shalise, you mentioned about Roth IRAs and them being tax, you don't have to pay taxes when you get that income later. Dr. Ren, what are the tax implications of those stocks and bonds and EFT or ETFs?
ETFs.
Yes. So what are the tax implications of those?
Well, you simply pay the, capital gains taxes, in addition to your, the numbers you see in your tax returns. There's no special treatments if you do the regular investments in your brokerage account. So,
And you pay those
yep,
every year when you file.
exactly, yes.
Thank you for sharing. Well, this is a good time for us to remind everyone that's on the Zoom. Tax season. Taxes are due in two
Oh,
days.
yeah.
If you need a free resource, there's the Volunteer Income Tax Assistance Program, or VITA, at United
Mhm.
Way of Denton County, where you can file your taxes for free if you meet their qualifications. So, thank you. That made me think of that.
Got a couple more minutes. I know you've got some people here. Any of our students have any other questions? Or if you want to put in, are you currently investing? Is anybody using a Roth IRA or maybe a robo-advisor? Anybody into crypto? I'm just curious. If you are, you can put that in the chat. Would like to hear if you are currently investing in some level. I will say I wish I'd got into my Roth IRA sooner. It's great now, but I don't have as much time as these young people in college. Um, we've got a quiet group tonight.
Oh, by the way, there's one thing that I want to add to the cryptocurrency part. It's like now, if you want to buy the real cryptocurrency, like you want to buy one Bitcoin, you have to have like an account in those cryptocurrency exchange, for example, Coinbase, or I don't think you can buy the real Bitcoin from Charles Schwab or anywhere, but if you want to, expose yourself to the cryptocurrency, you can try the Bitcoin ETFs, which tracks the price changes of those cryptocurrencies. And those ETFs, again, are traded like single stocks that, you can just buy one share of those ETFs that tracks the price changes of Bitcoin from, your own brokerage account. So, yep, just something came to my mind that I want to share with the audience here.
Thank you, Dr. Rin. And we got a question in the chat.
Yep.
So Ireland wants to know, they are not using a Roth IRA right now, but wants to start one. Are there any resources or places that you would recommend they look at?
Well, to be honest, I'm not an expert in the retirement planning part. Again, I would recommend Ireland to subscribe to our YouTube channel. I think I saw there are at least 2 to 3 videos. Dr. Megan Burke talked about retirement planning. I think she has better suggestions for you. So please, if you have time, you may watch the videos on our YouTube channel there. I just do not want to deliver some, wrong messages here because simply because I'm not an expert on the retirement planning part. But sorry about that.
It's okay. And Dr. Burke had some really great information, and that video is
Mhm.
up if anyone wants to click on the link in the chat. We went ahead and dropped in there. I will also say I'm a big fan of NerdWallet. NerdWallet's really good at being unbiased, and it shares information. It'll collect information, about credit cards, about different high yield savings accounts, about Roth IRAs, and then it'll show you some key points on each of the different ones so that you can evaluate and make a choice, an informed decision. So I might just throw that out there, and I'm sure they have information on Roth IRAs, so somewhere to start.
All right. Well, we're coming up on time. And again, thank you, Dr. Wren. This was really interesting. And you were so calm in your presentation, which kind of helps demystify like investing. And thank you very much for your expertise and really some sound advice for a lot of our beginners on Zoom. We look forward to more sessions with you. We'll definitely bring you back in the fall. Please take a few moments for those of you who are going to be exiting the Zoom here in a few minutes and answer that anonymous survey for us. We thank you for doing that. And everybody, thanks so much for being part of Maroon Money Month. And we hope you have a really nice evening. All right. Thank you, Dr. Wren.
Thank you, Chalice. Thank you, everyone.